Today's news has devastating consequences for your retirement portfolio, your real estate equity, and your ability to preserve wealth in the most unpredictable housing market Canada has seen in decades. If you own a pre-construction condo, hold a pension tied to real estate assets, or have a mortgage on a property in the Greater Toronto Area, what I'm about to show you in the next 30 minutes will fundamentally change how you see the Canadian housing market forever. Last week, Statistics Canada confirmed something they had been quietly burying in footnotes for months. Canadian business insolvencies just hit a 15-year high, and the single sector driving that collapse, construction, up over 30% in 1 year. The official explanation, a temporary slowdown due to rate sensitivity. The real reason, a mathematical impossibility that has finally broken the system. It costs $800 per square foot to build a condominium in Toronto today. The market will only pay $750. Every single new project that breaks ground right now is a guaranteed bankruptcy before the first tenant moves in. This is not a glitch. This is not a cycle. This is the controlled demolition of the industry that was supposed to solve Canada's housing crisis. And this part has already begun. In the next 30 minutes, I'm going to show you three things. First, how the construction sector's insolvency wave is not just a business story, it is a systemic fracture that directly threatens the wealth of hundreds of thousands of Canadians who put deposits on homes that will never be built. Second, how the mechanism behind these failures, the fixed price contract trap combined with runaway construction costs, has quietly entered a death spiral with no off-ramp in sight. Third, how this cascade ends with a supply air pocket so severe that the housing crisis does not resolve, it reloads. And by the time you feel it in real estate prices in 2028 and 2029, the exit doors for affordable home ownership will already be locked. By the end of this, you will understand why this is not about developers or cranes or headlines. It is about your retirement savings, your real estate equity, and whether the asset you were counting on to anchor your financial future is sitting on a foundation of promises that no one can keep. But we haven't even reached the most alarming part yet. To understand what just happened to the Canadian construction industry, you cannot start in 2025. You have to go back to 2021 and 2022, when a combination of near zero interest rates and explosive urban demand created the most frenzied pre-construction sales market in Canadian history. That is when developers built what I call the paper building, a system that let them create the appearance of a thriving construction pipeline where only a structural time bomb existed. Here is the part they never put in the official reports. Developers in 2021 and 2022 were selling thousands of pre-construction units at fixed prices. A buyer would walk into a sales office, sign a contract for a $500,000 condo to be delivered in 2025, hand over a deposit, and walk away believing they had secured their future home. The developer had a different calculation. They assumed inflation at roughly 2% annually. They assumed interest rates would stay low. They assumed construction costs would remain stable. They assumed wrong on every single count. And that is when the trap snapped shut, because what comes next is worse. By the time 2023 arrived, the math had completely inverted. Inflation had run as high as 8%. Construction materials were up. Labor costs had surged, and interest rates had risen at the fastest pace in Canadian history, crushing buyer demand and freezing the secondary market entirely. Think of the construction sector as a three-story building. Level 1 is the foundation layer. This is where real economic value is produced. Subcontractors, tradespeople, material suppliers, and the raw labor force that turns blueprints into physical structures. These are the electricians, the plumbers, the concrete crews, who are the first to know when a project is in trouble because they are the first to stop getting paid. Level 2 is the developer layer. This is where units are pre-sold, financing is arranged, and contracts are locked in. This is where the $500,000 promise was made to the buyer in 2021. Level 3 is the financing layer. Banks, lenders, and construction loan facilities who put up the capital against projected sale prices and projected margins. This is where the leverage lives. Here is what nobody explains. As long as all three levels move together, the illusion holds. But when construction costs blow through the ceiling and buyer demand collapses through the floor, level 3, the banks keep demanding repayment on loans that were calculated for a world that no longer exists. Level 2, the developers cannot raise the sale price on a contract they signed 3 years ago. And level 1, the tradespeople simply stop showing up when their invoices go unpaid for 30, 60, 90 days. This is where common sense actually becomes your enemy. You might think a developer who cannot finish a building simply sells the project, finds a buyer, moves on. That is the intuitive response, and it is exactly wrong. Here is the part even analysts tend to miss. When a developer runs out of cash in this environment, the lender does not wait. The lender appoints a receiver, and a receiver's job is not to finish your condo. A receiver's job is to liquidate the asset, to sell the raw land, recover the bank's capital, and walk away. The building stops. The cranes come down. The site becomes what industry insiders are now calling a ghost site, a mud pit with an excavation hole and no future. This is vanishing in real time. Since the start of 2024, nearly 7,000 pre-construction condo units in the Greater Toronto and Hamilton area have been cancelled outright. Not delayed, not restructured, cancelled. Those homes effectively evaporated, and the pipeline for new completions in 2028 and 2029 is not thin, it is empty. The data forces one conclusion. New condo sales in the GTHA have dropped to levels not seen since 1990. That is a 35-year low. For the average household trying to plan their housing future, for the pension fund with real estate exposure, and for the first-time buyer who was told that the pre-construction market was the only path to affordable home ownership. This is not a soft landing. It is a controlled demolition of the supply pipeline. But that is not the real problem. Let me show you the math that nobody on television is walking you through. In 2021, the average hard cost to build a condominium in the Greater Toronto area was sitting at roughly $650 per square foot. Manageable, tight margins, but workable. In 2022, as supply chains fractured and labor markets tightened, that number moved to $720. Developers adjusted their projections, raised a few eyebrows, kept building. By 2024, hard costs had crossed $800 per square foot, a 20% surge from pre-pandemic baselines. And here is the part that makes this a certainty frame, not a prediction. The market, due to rate-suppressed buyer demand, would only absorb $750 per square foot in sale prices. This is not theoretical, this is observable. Every single project that sign pre-sale contracts in 2021 and 2022 locked in sale prices based on a world that no longer exists. They are legally obligated to deliver a product that now costs more to build than it will ever sell for. That gap, that $50 per square foot loss on every unit in every building, is what I call the profitability gap. And it is the mechanism hiding in plain sight. Add it up. On a 200-unit mid-rise building averaging 800 square feet per unit, that gap represents a loss of $8 million before you account for financing costs, soft costs, or carrying charges. The rope holding the balloon down has snapped, and here is where the first domino falls. When the developer acknowledges the profitability gap is unsurvivable, they have two choices. They can bleed slowly, drawing down reserves, delaying subcontractor payments, hoping rates drop and buyer sentiment reverses, or they can file for insolvency protection, hand the keys to the receiver, and walk away. In 2025, 30% more construction companies chose the second option than the year before. That is not a statistical blip. That is a sector-wide acknowledgement that the math does not work. Here is what that looks like on the ground. For the subcontractor, the plumber who installed rough-in pipes on floors 1 through 12, it means receiving a legal notice that the developer is insolvent. It means filing a construction lien against the property just to protect the $140,000 in unpaid invoices. It means watching a court-appointed receiver sell that property, often at a significant discount, to recover the bank's position first. The subcontractor collects what is left, which is frequently nothing. For the average household in Ontario, this is catastrophic, because here is the mechanism nobody explains when they sell you a pre-construction unit. Your deposit, the $150,000 or $200,000 you handed over as a show of good faith, did not sit in a trust account waiting for your keys. In many cases, developers were legally permitted to use deposit funds to cover soft costs, marketing, zoning applications, architectural fees, early-stage carrying costs. The money was deployed the moment it arrived. When the developer files for insolvency, your deposit becomes an unsecured claim. You join a creditor queue that puts you behind the construction lender, behind the receiver's fees, and behind any secured creditors with registered charges against the property. The Tarion Warranty Program in Ontario does provide some deposit protection, but the coverage caps, depending on the year of purchase, sit at $60,000 on a standard unit and $100,000 on a higher tier purchase. If you put down $150,000 on a luxury unit in 2022, you may recover $60,000. The remaining $90,000 is simply gone. This is not a prediction. This is already happening to thousands of Canadians right now. And this is where the cascade becomes unstoppable. Step 1. The profitability gap makes new project launches financially irrational. Developers do the math, see the loss before the first shovel breaks ground, and quietly cancel their launches. New condo sales drop to a 35-year low. Step 2. Existing projects that are mid-construction, already 2 years into a 4-year build cycle, hit the cash wall. The developer stops paying subcontractors. Construction lines begin appearing on title. These are the canaries. Step 3. The lender receives notice of multiple construction liens, triggering a review of the construction loan covenant. The loan goes into technical default. The lender appoints a receiver. Step 4. The receiver's mandate is recovery, not completion. The site is secured. The cranes come down. The ghost site is born. A hole in the ground, fenced off, with no activity for months. Step 5. Buyers holding pre-sale contracts receive notice that their project has entered receivership. They are now unsecured creditors. Their real estate purchase, the cornerstone of their financial planning, their retirement strategy, their long-term wealth accumulation plan, has been reclassified as a bad debt. We are watching every step of this sequence play out simultaneously across dozens of sites in the GTHA right now. This is not a scenario. This is a live event. Here is the part that scares me most, because while this cascade is destroying existing projects and existing buyers, it is simultaneously destroying the future supply pipeline. And that is where the story shifts from a real estate crisis to a systemic wealth preservation crisis that affects every single Canadian, whether they ever bought a pre-construction unit or not. Let me be precise. The homes that were supposed to be completed in 2028 and 2029 require construction to begin in 2025 and 2026. That construction is not happening. The developers who would launch those projects are either already insolvent, sitting on losses from their 2021 vintage contracts, or rationally refusing to start new projects where the profitability gap makes success mathematically impossible. The data is unambiguous. New condo sales in 2024 hit a 35-year low. The projects not launched in 2024 cannot be completed by 2028. That is not speculation. That is a construction timeline reality. And what this creates is what sophisticated real estate analysts are calling the supply air pocket. Here is what that looks like for the average household. Right now, demand is suppressed by high interest rates. Buyers are sitting on the sidelines. Prices have softened in some segments. The headlines suggest a balanced market, maybe even a buyer's market in select categories. And the brain says, the crisis is over. The prices will correct. Wait and buy. This is where normalcy bias becomes your worst financial enemy, because the demand that is suppressed today does not disappear. It accumulates. Every year of delayed purchase is a year of household formation, of immigration-driven demand, of population growth that has nowhere to go. Canada is adding hundreds of thousands of permanent residents annually. They all need to live somewhere. When interest rates eventually normalize, and that moment is already in progress, that suppressed demand does not trickle back into the market. It floods back into a supply pipeline that is, for all practical purposes, empty. And this is where the cascade becomes personal. For the household with a pension that has exposure to Canadian real estate investment trusts, the supply air pocket means rental income growth, not decline. It means the Ray T that owns existing apartment stock becomes enormously more valuable as rental demand surges against zero new rental completions. For the household with a mortgage renewal coming in 2027 or 2028, the supply air pocket means the collateral value of their existing home does not collapse as many predicted. Existing supply becomes the only supply, and prices for existing homes are supported by the structural absence of new competition. For the household holding cash and waiting for a price crash, the supply air pocket is the event that never arrives, because you cannot have a sustained price correction in a market where new supply has been systematically eliminated. But here is the part nobody expects. The very forces that are destroying today's builders are quietly setting the stage for the most severe housing affordability crisis Canada has seen in a generation, not because prices will crash, because they will not, and because the people who most need affordable housing, first-time buyers, young families, immigrants entering the market, are the ones who will face a 2028 market with no new supply, surging demand, and price levels that make home ownership structurally inaccessible. Your 401k equivalent, your RRSP, your retirement timeline, your entire financial plan assumed a housing market that would eventually normalize. What the builder's graveyard tells us is that normalization is not coming. The market is not resetting. It is reloading for a price spike that will make 2021 look modest by comparison. And this is where the domino sequence enters its final phase. The reason most Canadians will not act on this information until it is too late has nothing to do with intelligence. It has everything to do with psychology. And this is the mechanism hiding in plain sight. The first trap is normalcy bias. The construction sector has been under pressure before. Recessions come and go. Developers fail and new ones emerge. The brain pattern matches to every previous cycle and concludes that this time is the same. It is not. The insolvency rate hitting a 15-year high is not a cyclical fluctuation. It is a structural break. The conditions that allowed developers to survive previous downturns, cheap financing, stable material costs, and reliable buyer demand have all reversed simultaneously. There is no historical precedent for this specific combination in the Canadian market. The second trap is the money illusion. You look at a condominium listed at $650,000 and think it is expensive. You are measuring it against a currency that has been silently debased, against the actual purchasing power destruction of the last 4 years, against the construction cost inflation that has made replacement value $800 per square foot. That $650,000 unit is not overpriced. It is underpriced relative to what it would cost to build a replacement today. And that gap is what preserves prices even as demand softens. The third trap is narrative control. When a financial news segment calls this a temporary dislocation in the construction pipeline, or a natural correction in an overheated segment, they are not describing economic reality. They are managing your emotional state. They are providing you with a framework that makes inaction feel rational, because inaction keeps you in the system. It keeps your retirement savings in the same instruments, your mortgage with the same lender, your portfolio with the same allocation it had before you understood what the builder's graveyard actually means. This is not a conspiracy. It is a stated policy of managed perception. Here is what the average household in Canada is actually sitting inside right now. Your pension fund, if it has Canadian real estate exposure, is positioned in a market where existing real estate assets are becoming scarcer by the quarter. Every insolvency that kills a project adds to the structural undersupply that supports existing asset values. From a pure portfolio risk perspective, existing real estate in major Canadian urban centers is not a bubble waiting to pop. It is a constrained asset class experiencing a supply-side compression event. Your mortgage is secured against a property whose replacement cost is rising, not falling. The bank that holds your mortgage is not sitting on a depreciating collateral position. They are holding collateral whose intrinsic value, measured against what it would cost to build a comparable structure today, is increasing every quarter. Your RRSP or TFSA, if it holds Canadian bank equity, is holding institutions that are the secured creditors in every one of these receiverships. The banks do not lose in this scenario. They collect first. They recover principal. They acquire land at distressed prices through receiver sales and reposition it for the next cycle. The system is not failing for institutions. It is failing for individuals. And here is where everything changes. The binary choice that the builder's graveyard forces on every Canadian household is not between buying and renting. It is not between condos and detached homes. The real binary choice is between understanding your actual exposure and remaining comfortable in the narrative that things will normalize. Let me be direct about what portfolio risk management looks like in this environment without telling you what to do with your specific situation. If your retirement timeline is 10 years or longer, the supply air pocket is a structural tailwind for existing real estate holdings. The absence of new supply completion in 2028 and 2029 means rental demand against existing stock intensifies. Yield compression in rental assets reverses. Cash reserves positioned for opportunistic real estate acquisition in 2025 and 2026 at current distressed developer pricing represent a fundamentally different risk profile than waiting for a price correction that the supply data suggests will not arrive. If your wealth preservation strategy assumed that housing affordability would improve before your retirement window closes, the builder's graveyard data forces a reassessment. The conditions required for sustained price correction, significant new supply entering the market, are not present and will not be present for at least 3 to 5 years, given current construction lead times. If you hold a portfolio with allocation to Canadian real estate investment trusts or Canadian bank equities, the receivership wave is not uniformly negative for those positions. Banks recover secured claims. REITs holding existing rental stock benefit from the supply vacuum. The risk is not in holding existing assets. The risk is in the assumption that new supply will normalize the market before your financial planning window closes. Here is the part the experts gloss over. The buyers who will navigate this environment successfully are not the ones with the most sophisticated charts or the most aggressive market timing. They are the ones who understand the single most important distinction this crisis has revealed. Do you own real estate or do you own a claim on real estate? If you hold a pre-construction contract signed in 2021 or 2022, you own a claim, a legal promise from a developer who may already be in receivership or who will be before your closing date. The carry-on protection covers a fraction of your deposit. The bank collects first. You stand in a creditor queue holding an unsecured position. If you hold title to an existing property with a registered mortgage, you own the asset. The replacement cost inflation that is destroying developers is simultaneously protecting the collateral value of what you already own. If you hold gold, hard currency, or inflation-linked instruments as a wealth preservation layer within your portfolio, you hold assets whose value is measured against the same purchasing power destruction that is making construction economically irrational. In every major real estate dislocation in modern economic history, the households that preserved their wealth were not the ones who predicted the crisis most accurately. They were the ones who quietly moved from paper promises to tangible positions before the creditor queue formed. The queue is already forming. The government announced 4 million new homes. They funded accelerator programs. They held press conferences. They put the number on posters and podiums and policy documents, but you cannot build 4 million homes with companies that are filing for insolvency at a 15-year high rate. You cannot fill a pipeline with projects that cannot be launched because the profitability gap makes every new start a guaranteed loss. You cannot solve a housing crisis by bankrupting the builders. The construction sector did not stumble. It tripped over the math it has been ignoring since 2021. And now every Canadian household, whether they know it or not, is living inside the financial consequences of that collision. In the next episode, we are going to look at exactly how the supply air pocket unfolds through 2026, 2027, and into the 2028 price environment, and what the 3 specific signals are that will tell you the reload is happening before it appears in any headline. Because by the time it makes the news, the real estate window will have already closed. Stay vigilant, stay informed, and above all, understand whether you are holding the asset or just holding the promise of one.